Good morning, everyone. Welcome and thank you for joining us for today's program, 2020 M&A Year in Review, Lessons Learned. My name is Meagan Kalantar, and I'm an attorney here at Williams Mullen in our Virginia Beach office, and I am joined by my esteemed colleagues, Ppp Goodpasture and Larry Parker. We are all members of our firm's M&A practice and have experience representing both strategic and financial buyers and sellers in a wide range of transactions. This year was no exception. Despite facing unprecedented circumstances in the face of COVID-19, we've actually seen an upward trend in M&A activity this year. Today's program will cover some of the unique elements that our team has encountered this year and provide some thoughts on what we anticipate seeing in the upcoming year. A few housekeeping items to go through. First, if at any point you have a question, you can submit that question by using the Q&A button at the bottom of your screen. We'll try to answer them in real time, but if we can, but we'll also take questions at the end of the presentation. If you are having any audio or technical problems, please use that same Q&A button and our helpful marketing folks will get those resolved for you. And then finally, there's no need to write down our every word that you see in this presentation. We will provide you with a copy of the presentation by email later today. Okay, so let's get started. Larry, this first question is for you. Thanks again for being with us today. But what are you seeing, Larry, in terms of determination of target working capital amounts in this brave new world where normalized working capital is no longer normal?
Well, Megan, it's really anybody's guess. The typical way a buyer and seller determine working capital is, you pick a point in time that's close to closing and you go back, say 12 months. If it's a business that doesn't have seasonality, and you take an average of the various components of working capital and you say, okay, over the last 12 months, we've had this quantity of accounts receivable, this quantity of cash, this quantity of inventory. You average it all together and you come out with a working capital target, and you true up either by estimate at closing and following closing, or just following closing. The challenge this year is if you were to do that 12-month math exercise, somewhere around March, things go haywire. So it's really limited to the party's creativity on how you solve that problem. One way to do it is just to have March be the time you do 12 months looking backwards. You could look over several years around the same time of year that you intend to close, sort of like you would do in a seasonality calculation. But there really is no right way. I guess you're fortunate if you're in an industry where there is working capital. A lot of industries that we're really looking at possibly distressed type sales, and the working capital is the last thing everybody's thinking about. But it's a challenge, and there's no right answer. If you're a relatively stable business and you expect a return to stability, probably the simplest thing to do is to go back to March and do 12 months prior, and that's how you calculate your target. But then things are really get interesting, because then, okay, well, how do you do your true up? Is the true up to the target? Do you give people a bigger collar, perhaps, because there's so much uncertainty day to day still with this? So that's a whole nother set of challenges that buyers and sellers have been dealing with. So there's no simple answer, unfortunately. There is no such thing as normal in working capital anymore, everybody is just working through it together.
Yeah,
I just chime in with I think that the situation we live in has heightened the need for due diligence on the quality of the receivables and the age and stress on the payables. Hopefully that's all very transparent, and the parties are very open about that. But anyways, it could well be that you're stepping in
Right.
higher to something that's in a lot of stress.
And a lot of the normal methods for doing a true up post closing go away. I've got a client that inventory is a big part of their working capital, and usually what they would do is a physical inventory either shortly before or shortly after closing, and that's become virtually impossible. So you have to rep around that. The seller generates inventory by virtue of their internal reporting systems, and they have to rep that that's true, because there's not a feasible physical way to verify that inventory right now because of the inability to bring people into close spaces and do face-to-face.
That's great. Thanks, Larry. And what about in the earnout context? What are you seeing folks do in terms of gauging or trying to estimate the probability of either receiving payment of an earnout payment or having to pay one out if you're on the buy side, when along the same lines, the concepts of revenues and earnouts being normal may also be gone for the foreseeable future?
Right, and earnouts are a great way to bridge, valuation gaps, and it was an obvious thing to come back in this sort of deal environment that if you're in an industry where pre-COVID, you were doing 5 to 10% of the purchase price as earnout. Now you're bumping up, and maybe it's 20 to 30 or even upwards of 50% on earnout. But in some respects, that's pushing the problem down the road a little bit. The challenge is for both buyer and seller. Okay, well, how do we agree on what the target ought to be in order for seller to earn an earnout? Buyer is typically going to want that to be a little bit more of a stretch objective, and seller's going to want it to be something that's a little more attainable. And that the other question is, are we going to do it based on revenues? Are we going to do it based on EBITDA? And if you go down the EBITDA path, what on earth is an appropriate add back nowadays? Do you add back expenditures that are required for PPE or plexiglass or all of these other things that are a little bit out of the ordinary? And then where does it stop? And on the revenue side, at least revenue is a little bit easier to determine whether revenue is revenue or not. But there's the classic problem with revenue is if the folks who may earn the earnout are the ones that also generate sales and generate revenue, that the buyer is heading down a dangerous path without taking expenses into account. And you factor in the fact that nowadays both parties don't really know what either revenue or EBITDA is going to look like in 3 months. It's always a little bit of a guessing game anyway, but now there's so many things that are up in the air in terms of the predictability of cash flow, revenue, EBITDA, that it's very hard for either a buyer or a seller to gauge, exactly what the way to measure it is, when to measure it is, and what the right targets are. I personally, if I were representing a seller, I would strongly think about looking at longer term earnouts. In other words, maybe this next year is a wash, and your earnout is based on 2022 primarily, as opposed to 2021, which could be a great year or it could be a not so great year. The other solutions that I've seen is including ways in which failure to hit a target in 21 can be made up in 2022 if you well exceed the 2022 target. But a lot of thought and a lot of challenges to be overcome here. And, I'll go ahead and pivot to the add back thing now. I mean, in a buyer, when I'm representing a buyer, part of the reason why I'm amenable to revenue is because I hate the arguments about what's appropriate to add back. Whenever you're measuring on EBITDA, that is a lawyer's full employment act, because you can spend weeks arguing about whether we're going to include, PPE costs this year, but garden variety capital expenditure type costs in other years as reductions to EBITDA. So I tend to personally prefer revenue because it's simpler, and that takes the add back conversation out. But then then the focus turns on to, okay, well, post closing, what sort of operating covenants are the parties going to agree to, so that one party can't manipulate the earnout to its advantage. For example, from seller's perspective, you want the buyer to have, if you can get the buyer to agree to it, a duty to attempt to allow the earnout to be earned, or even better yet, maximize the earnout. As a buyer, you're going to be quite reluctant to take on either one of those obligations, because the buyer wants to buy the business and be able to run it the way it needs to run, and the earnout, let it work itself out. But this year, more than most, people, because there's a greater portion of the consideration typically in an earnout deal coming through the earnout, both parties are focused on what those post-closing operating covenants ought to look like. We can talk a little bit more later about other ways that the operating covenants have been heavily negotiated this year.
I'm seeing the same thing Larry's talking about. Earnout periods going out as far as 2023 and 2024, which a seller can be pleased about if they see synergies and comfort in their ability to control the operation post closing. But I do also think that COVID, what we've learned here is you got to make sure you feel comfortable about your buyer, and you might need to do some due diligence to make sure where their position is going to be going through this and post COVID.
So the longer you go out, the more you need to focus on those covenants too.
Right.
I mean, if, for example, I'm typically, when I'm presenting a buyer, reluctant to put in change of control accelerations, but if you're going out to 23 or 24, you might need to accelerate that earnout on a change of control, and then that's a whole nother round of things to think about. What if you sell this business in a basket of goods? How do you determine how the earnout is measured then?
Or if it's not just an earnout, but a multi-step sale, 60% round one, then 10, then start talking about a floor. And so there's real clarity to the seller.
From a seller's perspective, just pay the max and I'm happy. Right. But I mean, obviously, if you're representing the seller, that's the way to go. We're going to have a change of control acceleration, and you're going to pay the max, and that'll make your life easier, buyer, and you can just move on and not worry about that.
Mm-hmm. Another concession I've seen parties make in an effort to kind of defray some of the uncertainty around earnouts is to give the seller an opportunity to earn a prorated amount of the earnout. So instead of having a hard and fast target where it's kind of all or nothing, they'll say if you hit, at least 75% of the target, we'll give you 75% of the earnout payment, and up, some sliding scale up to 100. So that's been a concession that we've made in a deal for a seller who was uneasy about the prospect of having to hit, one number and it was all or nothing.
Yeah, absolutely.
Larry, turn to the specifics of COVID. What are you seeing about PPP loan treatment in this era?
Okay, well, PPP loans, probably the three of us are probably sick of talking about PPP loans, but The biggest issue with these now is, we've transitioned to the phase where we were expecting to have been receiving forgiveness. Originally, the program was designed so that repayment might begin as soon as last month. Well, obviously that hasn't happened. The SBA's put out now guidelines on how you go about approving a change of control. And the issue there is it's a two-step process. The typical PPP note has a change of control trigger. In other words, if a change of control happens, a sale of assets, stock, or merger, then the note could accelerate and trigger a default. And the step one is making sure the lender's on board with the change of control not being a default. But that's not where the discussion ends, because embedded in the SBA's rules, not necessarily related to PPP, but SBA loans in general, is that in that sort of situation, in order for the SBA guarantee to still hold, the SBA also has to approve the change of control. And this is where things get interesting, because typically those are pro forma approvals. And before the SBA had adopted a process under the PPP program, it was challenging in terms of cutting through the bureaucracy, but not in terms of time to get that approval. We had several clients that were able to do it in the matter of a week to 10 days. Now that there's a formal process, it's taking much longer. So what that means is, in this period where we're uncertain, where the most PPP lenders are uncertain, or borrowers rather, are uncertain whether they're going to receive forgiveness. Some have begun applying for forgiveness. How do you close a deal with a PPP borrower? And the answer most lenders are coming up with, and it's the lenders that kind of drive this process, is sticking an amount equal to the principal of the PPP loan into an escrow, and typically with the lender, and having that money sit there until forgiveness is given or not given. And if it's given, the money is paid over to the seller, typically, because it's typically the purchase price. A portion of the purchase price is set aside to secure this escrow / holdback. And if it's not forgiven, then it's just kept by the PPP lender. This is an imperfect solution because, as I mentioned, you're supposed to go through this up to 60-day process where the SBA approves its part. And a lot of sellers are deciding that they're going to take the risk of not getting that SBA approval and go ahead and sell and put the money into escrow. But that's that's a close run thing. It's not certain that that's going to work out well for those sellers. The other solution is to wait, but I've yet to see either a buyer or a seller buy into that. I do have a transaction now where the closing proceeds are less than what's owed under the PPP, and we're still looking for a solution to that one. But hopefully one comes forward here soon. But there's no easy answer on PPP, but it seems like the go-to is setting aside the funds in escrow and waiting for forgiveness, and either giving it to the lender or giving it to the seller.
The latest twist is now you have a second bill potentially, or maybe more, coming down, and I'm seeing parties want to know where that one's going to come out, the one that's currently in the Senate.
Right.
So
you're definitely not going to take it this time if you don't need it. Absolutely need it, because the overhang has proven to be more than people were anticipating.
Right. And just deciding how you're going to treat post-closing, whatever happens with the loan, which in the big loans I'm seeing a lot of parties really think through. when and how they're going to ask for forgiveness. How about material adverse effect definitions when you're in the middle of this?
Yeah. Well, this is sort of played out how you might have expected it. So stepping back, material adverse effect is really intended to be an extraordinary set of circumstances. So you're only allowed as a buyer to get out of a transaction based on a material adverse effect if something unexpected and of significant magnitude and significant duration happens. So perhaps if you had signed an agreement in November with a long approval window, you might have been able to argue that COVID was a significant matter and it was durationally significant. But as a general matter, by March, if you didn't affirmatively say COVID was a material adverse effect, then a garden variety material adverse effect definition is probably not going to help you because this is a known condition by March. Of course, nobody perhaps knew that we'd still be where we are now with COVID, but it was certainly a known condition, and that is not the type of thing that MAE is intended to get at. So if you were down to trying to find a material adverse effect as a buyer, you're already in a bad situation. There's only been one case in Delaware that I know of where a court found there was a material adverse effect. You're much better served as probably both as buyer and seller if there are other things that you can layer into the document as closing conditions or termination triggers that define for you, the parties personally, what it is that needs to not happen in order for the deal not to close. For example, a particular financial metric. In the last significant economic downturn, a lot of banks had some challenges closing transactions, and you saw bank specific balance sheet metrics included in lieu of relying on an MAE for termination trigger. Anything that you can design that is going to fit your business, both as buyer and seller, is going to work a lot better than an MAE. But to address the pandemic specifically, what's been happening is, we've been carving out COVID as in and of itself as a material adverse effect, which is probably where courts would land if you didn't carve out because it's a known condition. But it's typically affirmatively carved out by the sellers and reasonably agreed to by the buyers. But what buyers have been doing is including the disproportionate effect concept, not just on this, but several of the other material adverse effect carve-outs. For example, change in financial circumstances. You typically want to have the ability to declare a material adverse effect if, for some reason, even though you're in industry X, COVID has impacted you more than your peers, and so buyers want to include that sort of add back where it's still a material adverse effect if there's been a disproportionate impact on the seller.
Yeah, I think just like you said, the big picture question of is the MAE meant to give the buyer an out for just a material change in the overall prospects, which could be as in 2008 and in 2020 due to a macro issue, or is it only as of execution of the contract, risk is shifted and the buyer now carries the risk of the enterprise future success, except for things unique or relatively unique to the buyer. And you just got to have that clear, because we've all learned now big things happen. They always did, but they've really happened in a fast succession over the last 10 years. About reps and warranties, common changes you've seen reflecting just this COVID.
Well, we probably could have done a whole presentation on reps. And since we're getting a little long on time, I'm going to focus on what's on the screen here. I mean, most common is customers and suppliers, and they're your typical customer supplier reps that, one, who are the most significant customers over the last 12 months, and have those customers change their buying pattern, and a similar rep with sellers. But the parties are focusing more on defining what that change means. Have any of these customers or suppliers asserted that there's been a force majeure? Have they declared a default? Have they delayed payment? Have they delayed orders? A lot of the things that can show that customer supplier or an important party for your seller is perhaps in distress, and help predict whether or not that's going to be a problem going forward.
Yeah, and I see that the supply chain issues are kind of unique that traditional reps and warranties wouldn't necessarily pick up, that are really worth carefully looking at, both relationships and just unique disruptions specific to the target. Reps and warranties insurance, I take it continues to grow as an option.
Yeah. And before we move on, just one additional comment to add on the reps and how those have evolved in the light of COVID. I'm also seeing really extensive disclosures on the sell side around COVID-19 and the impact that it's had on a particular target's business. And, they can be very expansive and almost resemble like risk factors in a PPM or some kind of public filing. So that's another thing you're seeing. Very detailed. This is ongoing. We can't predict the results of it, and here are the myriad of ways in which our particular business has been impacted by the pandemic. So, another twist.
Yeah, great point. And warranty insurance still out there. That's what we see.
Still out there. Carriers are still writing reps and warranties insurance, though their practices have changed a bit since the pandemic. And I'm going to cover these pretty quickly, but we're seeing carriers sort of across the board write into their policies exclusions from coverage for COVID-19 related issues. The scope of the exclusions may be negotiable depending on your particular carrier, and the exact phrasing can vary. And it's one thing to think about kind of on the front end of the process when you're shopping a policy and you're requesting quotes from carriers on their underwriting fee and premium and retention rates. Consider asking them to provide their proposed exclusion language for COVID-19. I encountered a situation in a deal where the carrier was very inflexible and their carve out was very sort of vague and indefinite. And they were not willing to entertain our incredibly thoughtful changes to their language. And instead we ended up with theirs, and the best we could do was convene a phone call with the counsel for the carrier to ask them what exactly they meant by their turn of phrase, that losses arising from any impact from COVID-19 would be excluded. And the best we got was examples. So just something to keep in mind. COVID-19 related issues may be entirely excluded from coverage under the policy. They've also sort of heightened their focus on due diligence issues around COVID-19, and you can probably expect during the underwriting process to see some questions that are particularly focused on what impact the pandemic has had on the insured's business. Again, customer and supplier relationships are a big focus in the diligence process for the parties, but also for the carrier. They want to know whether the supplier and customer relationships are intact or if they've been impacted. Also workforce issues. Are your employees in the office? Has there been any kind of outbreak? Are they working remotely? You might get questions around that. And supply chain issues. We're also seeing carriers exclude reps and warranties that are specifically geared towards COVID-19 related issues, or in some cases read in their own qualifiers into the reps for COVID-19 matters. Finally, along the same lines as the heightened due diligence during the underwriting process, the bring down calls can be more extensive. This is the call that takes place a couple of days before closing, where you sort of reaffirm for the carrier that the reps and warranties are true and correct in all material respects as of the anticipated closing date, and bring them up to speed on any changes. And you may get some questions that are particularly focused on these issues during that call. So with that, and continuing the conversation around specialized insurance, Philip, what are you seeing in the event cancellation world and event cancellation insurance?
Right. The main thing I'd say, obviously file the claim, and don't be surprised if there's some, the carriers are alleging that what is really a replacement event is quote unquote a rescheduled event. And so in other words, people are twisting language or trying to, because the language didn't contemplate the facts we're confronted with. And therefore, you're getting into a wait to see if who's going to litigate some key terms in the policies. And a lot of people, it's going to be worth it to let someone else litigate it and then see at the end how the language, because the language seems to be common among a lot of policies, but to see what the result is. But file your claim, get it in. More often than not, I'm seeing results that the clients expected, but some is not. And they're waiting out arguments about that. So,
Philip, have you seen arguments with insurers about voluntarily cancellations versus government ordered cancellations?
Yeah, I mean, you're seeing everything. You're seeing things like that. You're seeing what's a reschedule, when it's rescheduled to an annual event the next year, is that actually a reschedule? That's just you lost an event. You're seeing, though I think the insurance industry is beginning to realize these are all cancellations with some exceptions. So, but they're overwhelmed with the claim. So there's some resistance. So it's language is going to get defined. Some of the language is going to get defined by litigation, that's for sure. Another quick issue I'd bring up is in transactions, restrictive covenants, non-competes. I think people are seeing some real thought, depending on how much the industry is just on complete hold right now, that the non-compete period really doesn't apply during this hold. And that's also then brought up the concept, should you have a clause in the non-compete non-solicit that if another event like this happens, the non-compete does not apply, or the non-solicit or whatever does not apply during a period when the economy is essentially shut down. That's definitely arising directly from this event. And worth consideration, particularly if it's a very valuable part of the deal. So, are we running out of time? We are.
So,
Yeah.
yeah.
What?
Yeah.
Do we have any questions? Nope.
No, I don't think so.
All right. Doesn't look like we have any.
No. Okay. Well, thanks everyone for attending today's program. Hope you have a very happy holiday season, and please feel free to reach out to either one of us should a question come up sometime after this presentation ends. Thank you very much.
Thanks, everybody.
Thank you all.